QBE and AMP, and to some extent ASX, beat expectations. What does this say about that sector right now?
Look, I think it's the one that falls the most when the stock market declines, and it's the one that rises the most when stock markets do well. QBE is a fantastic business in terms of its return on equity, in terms of its performance. It's a category killer, if you like, in insurance, particularly in this country. Neither of them again are cheap anymore. I've got a valuation for 2010 on QBE of about $21.50. It's trading at 22, so it's really factoring in what I've got forecast for its performance for the next 12 months. AMP, similarly, 2010 valuation of just over $6. It's trading at about $6. So there's no bargains to be had here. If you're going to buy them at these prices, and you would have to assume that there's going to be a significant uplift in economic performance for both of these businesses in the next 12 to 24 months. If you think they're going to perform pretty much as they have recently, then there's no value to be gained by buying them today.
Let's take a look at Brambles now,
Sure.
also a top mover today. Talking about shares in this company, shares did surge today, more so on the outlook though, and of course that CHEP pallet business restructure announcement still, about 4 weeks away. The market's really waiting for the outcome of that. Just how important is the US to a company like Brambles?
Oh, absolutely critical. It's a massive percentage of the business. The interesting thing about a pallet business is, how do you keep track of the pallets? And that's always been a problem. There's been if we go back 10 years, there's just been restructure after restructure and merger and acquisition and divestment. It's just been a dog's breakfast really for a very, very long time. This is a business that to me has too much debt still, for my liking. They might argue that they're optimally geared, but I would say there are other businesses I can invest in that have less debt. And unlike the other businesses that we've talked about tonight, the AMPs and the QBEs, which are trading at about their value, the price of this particular company is way over what I think it's actually worth. So I've got a valuation of about $4.60 and it's trading at around $7.20 or thereabouts.
Okay. All right. This is something I've been looking forward with you, Roger. Taking a look now at our Outperform segment. So outperform is when we ask the brokers which stocks they are buying for their clients to outperform the market and outperform their competitors. Roger, which stock have you picked for us?
Well, look, if I was a broker, I think my job would be a bit easier. But managing my own money, they're bigger decisions.
Because you're on, I should explain, because you're on gardening leave in a sense, aren't you?
Yeah, absolutely.
At the moment, after leaving Climb, which you, of course, built
founded.
up. Yes.
That's right. I'm on gardening leave, I guess, or self-imposed until July next year. But in the meantime, I'm keeping track of the investments that I'm making, obviously. And one of the companies that I really like is a company called JB Hi-Fi. Now I've liked it for a long time.
Plenty of investors have liked that too.
Yeah, but I can remember being on here, I think, many weeks ago now, and somebody else came on and said, "No, look, JB Hi-Fi looks expensive. Its PE ratio is too high. It's got the highest PE ratio of all the retailers." I don't care about PE ratios. I don't think it's a good way to value a business. And so as a result, to me, JB Hi-Fi seemed cheap. But in fact, the cheapest time to buy it was when it was trading between $7 and $8 in sort of October, November last year. I think it was November. But the business now is still, despite the strong rally that we've seen, and everyone in complete disbelief about how strong that rally has been, the value of the company next year and the year after is higher again than where it is today. So the value for this the value of this business, its real worth, is actually going up at a great clip. And you want to buy businesses like that, and it's still trading at a discount to its future value.
There you go. There's Roger's pick, JB Hi-Fi. Stay with us on Market Moves after the break. The day's losers and what the brokers are recommending. Well, Macquarie Infrastructure Group was on that list of losers and is considering a split. The toll road operator, which runs the M7 Westlink outside of Sydney and a long list of tollways across North America and Europe, wants to divide its portfolio into two, with investors receiving securities in each of the funds. Credit Suisse says there is disappointment at MIG's lack of clarity on both the restructuring, also the split, which doesn't seem to address leverage issues. What do you think? And do you think a split is the best way to go here?
Well, hopefully we've got a minute or two to talk about this, because I've been on the record over several years saying that the model was unsustainable, and happy to have been right on that. There's a number of issues just from the announcement that you've just made about the company and the discussions that are going on about this particular company. Large shareholders in Macquarie Infrastructure Group, which include Macquarie Bank, would probably not want to receive securities in something that was illiquid. So I don't know how they're going to work through that. That's an interesting dilemma. Internalising the management, well, it strikes me that Macquarie Bank wants to get its house in order. It wants to fix things up so it looks good for it. But whether that's the right thing to do for shareholders or unit holders in Macquarie Infrastructure Group, I don't know. And the loss doesn't surprise me at all, because most of the profits over previous years have been road revaluations. And in fact, I remember looking at this particular vehicle a number of years ago and seeing that distributions were $1.2 billion or $1.3 billion, and yet total toll road revenue was about $250 million. Now, that isn't sustainable. And if profits are coming in through revaluations of assets, then when those revaluations end, you're going to get losses. So investors need to understand that a toll road is a jaw-dropping asset to own. If you and I were at a dinner party and you asked me what I did and I said I own the toll road, you'd say that's fantastic. But then if I told you how much debt I had and how little I get from it, you'd probably be glad you don't own it.
Roger, I do want to talk about CSL. Its shares slipped by 3.6%, despite apparently being a big winner from Canberra's plan to fight swine flu. Now, the government has agreed to buy 21 million doses of the H1N1 vaccine from the Biotech in a plan that has fast-tracked the vaccination process to protect all Australians. Let's talk about this and the effect on CSL. Just quickly, how much upside is there for CSL?
Look, it's not small and it's not overwhelmingly large. You know, these large orders are usually done at discounts. You know, there's not an enormous margin, and CSL aren't going to reveal what their margin is, obviously. That's commercial in confidence information, I guess. So we can surmise or we can assume what it's like. CSL, though, I have to say, great business. You know, fantastic prospects long term, and not particularly expensive. One of the few companies in the stock market at the moment that is actually at a discount to its value, and since probably June, July this year, it's one that I have been recommending.
Okay, thoughts on Amcor being upgraded by UBS from neutral to buy? What do you think about that? Yeah,
look, brokers have their reasons for and their models for valuing companies, but Amcor, for me, isn't an investment-grade business. It's just there are too many other businesses that are far superior in terms of their prospects, their economic performance and the quality of their management, and I prefer to look at those businesses. Amcor, for me, just doesn't rate a mention.
Are there any other areas that you think would be more beneficial at this time?
Look, CSL is a business that is trading at a discount to its intrinsic value, high rate of return on equity, modest levels of debt. JB Hi-Fi, which I mentioned earlier, Macmillan Shakespeare, half of its equity is cash. You know, it's got no debt at all, and it's got an enormous return on equity.
Just a minute to go on the clock. Would like to get your thoughts on Wesfarmers before we go.
Yeah, Wesfarmers is a business that has real issues around what it paid for Coles, and it needs to dig itself out of that hole, and that's going to take some time.
Is the Coles turnaround story one that you see moving quickly? Do you see things turning around for the company? Because it's presenting a rosy outlook. Is that the real picture?
Coles had $4.6 billion of equity at the time Wesfarmers bought it, earning 27% return. You and I, if we were going to buy that, we might have paid $8 or $10 billion for that, and we would have got an 11, 12, 13% return. Wesfarmers paid $22 billion for that business. Their return on equity from that purchase price is very, very low. It's going to take a long time to dig themselves out of that particular situation. That's not to say Coles won't do well. It's just that sometimes you can have a great asset that you've paid too much for, and it's going to take time before you're going to see real runs on the board.
It's just going to take some time and patience, you think?
Unfortunately, yes.
Roger Montgomery, thanks so much for joining us on Market Moves tonight. It's been great to get your analysis.
Thanks.